We have with us Kashish Kapoor, a finance content creator on LinkedIn and a passionate soul for everything finance related. Kashish is professionally associate at Wealth Desk and an expert in investing, content strategy, personal finance, and a lot more. Welcome to the session, Kashish. We are really, really glad to have you today.
Thanks for having me, Purnima. Glad to be here.
Yes, so let's get into the session right away because we're all excited. So, before we dive deep into the topic, which is investing tips for beginners and all, can you explain what mutual funds are and how they actually work? So, for the layman,
Yeah, sure. So, mutual funds, the best way to understand this would be is just a medium for you to invest, right? There are multiple ways you can invest. And before even we talk about investing, let's take a step back and talk about where can you invest. You can invest in stocks, you can invest in equities, you can invest in debt instruments. There are multiple instruments that exist. Mutual funds is a product specifically made for retail investors, which makes the process of investing relatively much more easier. So whenever we talk about investing, right, the first thing that comes to anybody's mind is mutual funds. And also, the popular campaign mutual fund sahi hai, the one initiated by AMFI. This has put mutual funds in a position where it has become synonymous to investing, which is a very good thing, because if anybody who thinks about investing, they should start their journey through mutual funds, because they still remain one of the easiest products to invest in and to start an individual's wealth building journey. Now, to answer what mutual fund exactly is, mutual fund is nothing. It's just, as I said, a product which is managed by a fund manager, someone who's experienced and who does stock picking and security selection for living. And you are able to avail his services at a fraction of a cost, and you invest in different securities through him. So mutual funds have separate mandate for separate mutual funds. It can be an equity mutual fund, a large cap, a small cap, a corporate bond mutual fund, a gilt fund. There are multiple. We can go on. I can go on speaking on each one of them separately for way long. But what's important to note is that there is a mutual fund for every type of investor out there, for every type of risk profile. What this enables us as retail investors is हमें बस वो एक mutual fund choose करना है, or a couple of them which suit us the best from a huge list of catalog of mutual funds that we have. So all in all, to cut it short, it's a product specially made for retail investors to simplify investments for you and to make sure that you're able to access wealth creation products through this in the simplest way possible.
right? So, beginners, when investing, how can they actually determine their risk tolerance? Like when they're investing in mutual funds, how can they know what
So
they're putting their hand into?
So that is a very subjective question, honestly, Purnima, because people that I've worked with at a professional level, at an individual level, all of them have a very different definition of what risk is. Okay? Some people define risk by the squiggliness of the stock price that they see. If the stock is moving way too much, maybe it's slightly risky for you.
Different people define risk profile in a very different way. As I said, some people think how much their portfolio is moving over time. How quickly is it moving over time? That's risky. So they simply cannot tolerate a 5 to 10% deviation in their portfolio, which is a justified way of defining risk. Some people define it risk is something which stops them from achieving their financial goals. So for them, true meaning of risk would be if I need, let's say, a crore at the end of 10 years, me not achieving that is a risk. So this then becomes a very personal question as to how do you want to define risk. And I personally prefer the latter. I think that if you're investing, at all times, your investments must you must hold them for longer durations of time in order to achieve the financial goals that you have. And in the end, the only reason you're making investments is because you have a goal that you want to achieve. And in that case, the true meaning of risk would be you not being able to achieve the goal through investments you've made. So when we say कि boss आपका risk level क्या है, that will depend on what your financial goal is, and then what product are you investing in. If you want to, as I say, let's go back to the same example, 1 crore at the end of 10 years, and for you to achieve that goal, you must at least be earning 12% CAGR over this decade. But still, you're investing in a product like an FD, which gives 6 to 7% return. You are making a very risky bet for your financial goal, because you know for a fact the investment that you've made is risky investment, even though it's still FD. Everybody thinks that, okay, FD is the safest option out there. But if that asset or that investment is not letting you achieve the goal, it is a risk that you're assuming. And I highly advocate people start viewing risk in a much more saner and rather in a much more unconventional way, the way I just explained right now. Because as I said, conventional meaning of risk remains कि मेरा portfolio कितना ऊपर कितना नीचे जा रहा है, and that really does not tell us a lot about why we are making investments, and will we be able to achieve the goals for which we started investing in the first place.
So I think what you said is going a little unconventional is the way forward, and looking at a long term goal.
Yeah, definitely.
So you just mentioned that there is a vast variety of mutual funds available. What is the best one? Which one is the best for the beginners? Since this is like a beginner centric session, which one is the best for beginners?
Again, I'll rephrase this question, where beginner itself is a very vague word. Now, when you're saying beginner, that person may be beginner to investing, but does this mean that that guy is a beginner in their career? If that guy is just starting out their career, a different set of mutual funds would suit them the best. But if that guy is in his, let's say, mid career, late 30s, early 40s, then his financial goals will be different. And accordingly, what best suits him will be different. And if somebody is in their late 80s, retirement stage pe hain, they are retired, and maybe they may need money, maybe they don't. For them, the best mutual fund would be different. So, to still answer the question that you have asked here, assuming most of the audience that we have here is young, you still have a long runway to build your wealth. And assuming you have the right insurances and you have a significant emergency fund to make sure that you have something to fall back on, the best, I guess, mutual fund would be an index fund. So index fund is an equity fund where you're investing in equity as an asset class, but you're investing in the top, let's say, 50 or 30 companies of India. And the likelihood of you losing money over a long enough period comes to zero. If you take a 7-year or a 10-year rolling period return for a Nifty index fund or a Sensex index fund, negative returns possibility is zero, literally zero. And chances of you beating the inflation is greater than 90-95%. So if you are someone who, as Purnima said, maybe a beginner per se, but still early in your career, choosing equity mutual funds will suit you best. And out of all the equity mutual funds out there, there are multiple options you can invest in. The best, the safest, the most obvious, and the simplest form of the vanilla product would be an index fund.
Also, tell us about the costs that are probably associated with investing in mutual funds, and how can they actually be managed by beginners in terms of probably career. Yes.
Fair enough. So the costs associated with mutual funds are very simple. The cost structure out of, when I say simple, I mean in a relative sense. Out of all the financial products out there, right? Mutual funds most probably have the simplest cost structure out there. And how it works is, usually the cost is charged, the cost itself is called a TER, total expense ratio, and it's in percentage form. Let's say if the TER of a mutual fund is 1%. What it means is, for every 100 rupees you invest, only 99 rupees is invested and 1 rupee is charged as an expense. Now, since you're investing through a mutual fund, through an AMC, there is a fund manager doing the job for you. There are a huge team of analysts constantly working for you to make sure that they make the best investment choices for you. So to support that, the AMC, the mutual fund company, they charge some percentage out of it, which is called a TER, or a total expense ratio. And I guess the best way to optimize for it, again, taking the example of index fund, is since in an index fund, you are investing in a predefined list of companies. You're investing in an index itself, Nifty or Sensex index. The costs here are very low. And when I say very low, I mean 5 bips, which means 0.05% of the investment amount. So if you're investing 100 rupees in an index fund, सिर्फ 5 पैसा goes to the mutual fund company. This way, you're optimizing for your costs already. So if you're a beginner and if you're investing in index funds, there isn't much you can do because most of the index funds offered are very, very cheap. Cost optimization comes into play when you're investing in some other mutual funds which are relatively more exquisite. Let's say a sector fund or a small cap fund or a mid cap fund. In that case, the expense ratio goes as high as 2.25%. So from a 0.05% to 2.25%. And it's not that in the sake of optimizing for cost, Purnima, we go for the cheapest option because good things don't really come cheap. Good things aren't free. The cost that is being incurred for investing in a mutual fund is directly, not always, but most of the times proportional to the value that that fund manager is giving. So I am totally in for being frugal, for saving your money here and there. But when investing in a mutual fund, optimizing for cost should not really be your primary concern. Obviously, you should try to look for the best possible option out there. But then again, just investing in a mutual fund based on ki iska expense ratio is the least, that won't be the optimum strategy for your investment portfolio.
Well said, well said. And I totally agree with that. Good things do not come free. Yeah. So, how can beginners actually diversify their investments in mutual funds for better risk management?
Yeah.
Risks obviously do exist, and when they actually come up, they probably are not very happily welcome. So, how can we actually look at diversifying our investments? Yes.
Sure. So, very well pointed out, right? It is a common, I wouldn't say perception, but it is widely recognized that diversifying is a very good risk management strategy. Don't put all your eggs in one basket. Matlab, if you have consumed financial content in past 1.5 year, every finance influencer would have chipped out this quote to you. And because there is some truth to it, if your investments are spread across a wide variety of securities and assets and mutual funds, let's say, the likelihood of you witnessing that risk or witnessing that downfall in your whole investment portfolio will be low, which makes a lot of sense. But then again, another thing that we should not ignore is that sometimes at the risk of diversification, we tend to over diversify. अब उसमें क्या होता है? Let's say you have 50 mutual fund schemes that you've invested in. Of your total net worth, each mutual fund scheme is just 2%. So even if, let's say, a scheme gave 50% return in a year, which may or may not sustain, that 50% return only got replicated on 2% of your portfolio. So dekha jaye, on that 2%, you only made 1 more %. Your total portfolio value only increased by 1%.
1%.
Compare this to you investing in a diversified set of mutual funds, let's say 3, 4, 5, where you have significant exposure of your net worth to these mutual funds. And if these guys perform well, the likelihood of you also performing well on your total portfolio level increases. So for you to diversify, obviously investing in just one mutual fund would be slightly risky. Assuming, let's say, you're investing in an index fund, and agar market down hai, then every mutual fund will be down. It's not that one or the other will be making you a lot of money. But if you're investing in a good set of 4 to 5 mutual funds, which are mutually exclusive, something that I'll come on to later, which are mutually exclusive, you're not only diversifying your risk, making sure that your downside is protected, but at the same time, you give yourself a chance to earn some money should they perform well. Because कल को if you have 50 funds, it is highly likely उसमें से 5 तो अच्छा perform करेंगे. But it doesn't matter how good they perform because you never had enough exposure to those funds. With that said, I'll jump back to what I was saying. 4 to 5 diversified funds which are mutually exclusive. What I mean by this is the funds that you have invested in, you have to make sure that these funds, the underlying securities that they're investing in, वो funds खुद भी कुछ stocks में, कुछ bonds में invest कर रहे हैं, they do not overlap. Let me give you an example. You have 5 mutual funds. All of them hold Reliance as their top holding for 20%. कहने को you're well diversified over 5 mutual funds. But if all of them have major holdings in, let's say, a stock like Reliance, your net worth is directly linked to that one stock. So you may look like a person who is well diversified. I own 5 mutual funds, but kal ko, if anything happens to Reliance, then you will be directly impacted. And the mirage of safety that you had under the veil of diversification never really protected you. So diversifying itself is a very smart strategy that you have to play with. Don't over diversify, but make sure you are actually diversified in mutually exclusive schemes.
Well put. Very wonderfully put. Thank you for that answer. Also, tell us about how beginners can actually interpret the historical performance of mutual funds, and if you could elaborate on what it is.
Yeah, sure. So every mutual fund ad starts or rather ends with mutual fund investments are subject to market risk. Read all scheme related documents carefully. And उसके बाद एक
Before
और चीज
investing.
होती exactly. And another thing that they say is past performance is not a representation of what future will be, which again is there is some truth to it, right? But if we can't, if we can't read or if we should not be looking at past performance, what other metric do we have to judge a mutual fund? I mean, the returns are the only thing that matter to me, right? And you're totally right in saying that past performance does not guarantee future returns, but this does not mean that I simply ignore it. So there is a way how you can look at it, and that this question gives me the opportunity to answer that, right? So obviously, looking at returns does not guarantee performance, but more importantly, what I want you to look at is if a fund has performed well consistently year on year, the likelihood of it performing well is also relatively higher compared to someone which has not. Now, let me give you an example for that, and maybe even a smarter way for you to look at it, right? Everybody, when you go to your favorite investment app, whichever app you choose, I personally use PhonePe का wealth app. I go to PhonePe, I click on वहाँ पे funds आ गए, and let's say वहाँ पे 3 year or 5 year return दिया हुआ. Everybody looks at 5 year return. It says, okay, this is the best performing fund, and this is the worst performing fund. Fine, but that is a very shallow way of looking at things. I want all my audience here to take away just one simple thing. It's better if you look at returns on a rolling basis. What do I mean by that? Over a 5 year period, let's say all of the funds started at 100. Over a 5 year period, fund A made you awesome returns till year 4. Every year it was performing well. Every year it was giving 20, 20, 20, 20, 20%. Very good fund. In the 5th year, it halved because of an uncertain event compared to a fund B, which had a very erratic performance. पहले 50%, then -10, then another 50, then -20, and then in the final year, it managed to give 100%. So if we look at the 5 year basis, we will be very impressed by fund B. Why? Because if we are looking at a point to point basis, from starting date to end date, the fund B performed really well. The total returns are insane. But if we look at a rolling basis, year on year, each year, how much returns did the fund give? We'll realize fund A was better. Fund A was consistently making the money. Maybe last year was not good, fine. I mean, markets, right? Anything can happen. But I will be more comfortable with a fund like fund A than a fund B. Now it all comes down to again your personal choices, which is why this question gets answered. How do you try to interpret returns? You have this knowledge now कि rather than just looking at point to point कि 5 साल में 100 का 200 हो गया, look at it each year कितना हुआ. 100 से वो 250 पे जाके if it come back to 150 again and now it's 200, is it a good fund to invest in?
Yes.
Totally your call. But if there is a fund which consistently made 100, 120, 140, 160, and finally 200, I personally would prefer that. So look at consistency of returns. Again, past returns do not guarantee future performance, but I can still make sense that if a fund manager is giving consistent returns, he will continue to give consistent returns. And I can still make sense if a fund manager is giving erratic returns, and if I invest today, there are high chances that my money goes down the drain the very next year. So looking at returns from this perspective adds value to your investment portfolio.
Wow. I mean, I also for a moment, like, I was just completely, taken aback by the way you were explaining it. It's amazing, and it's really, really well explained. Thank you so much. I mean, all my audiences and all the viewers are definitely enjoying, and we shall be having our public chat open shortly. Uh, what are the common mistakes, Kashish, that beginners make while investing in mutual funds? So there must be a lot of them, but if you could point out the most common ones, then we
Sure.
could be safe.
So I literally am writing a long blog on my website for this, which will go out soon. So this is a sneak peek into what I'm writing. And I'll just focus on one thing, which I guess drives most of the mishaps that happen with both my clients that I personally worked with or other stories in the industry that I've heard. And that is not setting the right expectations. Because in the end, right, investments is all about expectations. You expect that 10 years down the line, you would have made 12% return, which will make your portfolio a crore worth. All of this is expectations. All of these are expectations. If you do not set the right expectations, if you set the expectations that I should be choosing a stock or a portfolio or a mutual fund, which gives me 20% return each year for next 10 years, that is a wrong expectation. Now, how will this affect your portfolio? You're chasing a fund जो 20% देगा. Maybe you chose a fund today which did not perform as per your expectations but did decently well. You decided, okay, maybe this fund is not right for me. Next year, you jump ship to a new fund which gave best returns in last year. The next year, the fund that you chose did not perform well, and the fund that you ditched actually did perform well. You continue shifting the ship, you continue jumping the ship each time your chosen fund underperforms. And by the end of 10 years, आपने बहुत सारी funds के साथ experiment कर लिया, you would not have made any return. But had you stuck to any one of these consistently, you still would be much better off financially. So people set very wrong expectations with their investments, and then they have that itch to act. There's an adage on Wall Street, on the Wall Street rather, कि your equity portfolio, your investment portfolio is like a bar of soap. The more you touch, the more it shrinks, right? So setting the right expectations, make sure that you stick to what portfolio you've chosen, what mutual funds you've chosen, and have faith in your fund manager. If you consistently do this for 3, 5, 7, 10 years, you would be much better off than being the guy who set the wrong expectations and then was acting unnecessarily each year, churning his portfolio, selling, buying, selling, buying. That doesn't work, at least in the investment world.
So we would also like you to please tell us what is SIP, SW, and STP. We've
Yeah,
only heard SIP, but the other two terms have not even been heard. So yes, I mean, they're rarely heard. So I think you can
yeah, yeah,
explain it. Over to you.
sure. So everybody knows SIP, right? SIP full form is Systematic Investment Plan. It's nothing but it's a medium for you to invest in mutual fund. You've chosen, let's say I want to invest in XYZ mutual fund. SIP just sets up a process. Each month आपका 5,000 कटेगा, आपका 5,000 पैसा कटेगा, and it gets invested in that mutual fund. So that's an SIP. Now, what is an STP or an SWP? STP and SWP, both of these are on the very same principle. Systematic withdrawal plan or a systematic transfer plan. So what do I mean by that? As the name suggests, let's talk about systematic transfer plan. What does it mean? It means systematically your money gets transferred from one mutual fund to another. Now, where can this be useful? Let's talk about it. Let's say you were investing in a equity mutual fund, right? And you know for a fact, 5 years down the line, you would be needing that money. And eventually you want, from equity, I start shifting that money to debt because I know debt is safer and I'm reaching my goal. I do not want ki, when I am near my investment goal, another COVID happened, and if markets tank, I suffer badly, right? So what do? You set up an STP, a systematic transfer plan. Systematically, each month or at a predefined period, investments from one portfolio start going to another. So this could be one use case of STP. Another could be simply the underperformance. Let's say you stuck with a fund 5 years and it has not been performing well, and you finally made a call. Okay, maybe the fund manager is not doing well. I think I should start shifting. You will not be comfortable selling all of it on one go and then investing all of it in another. You'll be more comfortable systematically transferring that money month on month in a predefined period at a set frequency in a set amount. So if you have, let's say, 10 lakh invested, you would not be comfortable. You sell 10 lakh, all of it, and then investing rather 1 lakh karke each month if you're transferring that money. So STP is that tool, again, a medium for you to achieve these small tweaks in your financial plan. SWP, systematic withdrawal plan, as the name suggests. जैसे SIP में invest होता है, SWP is the opposite. It withdraws the money systematically, right? And this, I guess, is the best alternative to any retirement product that is sold to people in India. So people in India are sold retirement products in which actual are insurance products. You buy this and 10 years down the line, आपको इतना पैसा हर महीना मिलेगा. It will be like an annuity, right? And people who are not that financially savvy do not understand that maybe this product is not giving me decent enough returns, not even beating inflation, but I am getting the security. I'll get set money at the end of this period for X number of years. You can set up an SWP on your mutual funds and literally replicate what happens in a retirement plan, but with higher returns. If you, let's say, invested in a mutual fund for 10 years, 10 years tak SIP chali, now you are no more working, you rather need that money back. You can start an SWP on the same fund. The amount stays there, only the amount that is withdrawn comes to your bank account, you utilize it for your expenses, and the money that is invested still continues to grow. This makes sure that your mutual fund has actually now become your retirement fund. So SIP, STP, SWP, all of these work on a very similar concept, but have very minute tweaks based on what is your requirement and what stage of investment are you at. If you're early in your career, you'll set up an SIP. If you're late in your career, you'll set up an SWP. अगर आप बीच में हैं and you're like कि maybe I want to shift, you can set up an STP. So all of these are tools for retail investors like you and me, Purnima, to make sure that we are able to make the best out of mutual funds that are available.
So now let us also speak about tax implications for beginners in mutual funds.
Yeah.
Because that scares a lot of people away from these investment ways. So yes, please tell us about it.
So honestly, Purnima, I'll be very frank. I am no tax expert per se, but some very fundamental and basic things that I can share is, again, tax code changes each year. Okay? But I can tell a few principles that will remain true throughout. The fact is, every time you buy and sell and you earn a capital gain, you make a profit, you're supposed to pay tax, right? And every time you pay tax, you are hurting your own investment portfolio. So what's the best way to avoid tax? The best way to avoid tax is not sell and buy as frequently as possible. Because let's say you invested in a mutual fund at 100. Let's say 100 is the NAV, net asset value, or in other terms, simply the value of that mutual fund. When it goes to 120, you decided to, okay, let me sell it off. You earn that 20, but you'll never get that 20 because it gets taxed away at whatever rate there is. Let's say 115 आपके पास आया. Again, you decide to invest in a new mutual fund. You invest 115. That goes to 130. You decide to sell it off again, but again you incur the tax. How can you avoid that? You can avoid that by investing in a mutual fund at 100, not selling it and just sticking to it long enough. What this does is you are delaying your tax payment. And when you're delaying your tax payment, you're actually allowing your portfolio to grow quicker and more seamlessly. So that is one very important key takeaway, I guess. Second one, to avoid taxes, is again making sure that your investments are for longer term. Because when you invest for a shorter term period, let's say less than a year, your tax rate is always higher. So if you know for a fact कि मुझे छोटे टाइम के लिए इन्वेस्ट करना है, you should be ready to bear the brunt of taxes. And if you know कि if I'm investing for long term, booking short term profits does not make sense, because you might feel happy that you have that cash in hand, but you also have to make sure that Gandhiji is also taking away some part of it, Modi ji is taking away some part of it as well every time you sell it. So you cannot afford that if you are very serious about your investments and your goals. Yeah, I hope that clears some of the queries that you have. Again, not a tax expert, honestly. So, telling which is the perfect mutual fund or which is the best time to buy a mutual fund to make sure your taxes are saved at most. Not the right guy, Purnima.
No, but I think the basic idea behind it is that the longer we keep the money is when we get to pay the lesser amount of tax. So that's the takeaway, guys. Moving on to the next question. How can beginners actually rebalance their mutual fund portfolio for optimal performance?
Yeah. So now rebalancing will be again a function of what your financial goals are. Okay. If you are on your journey of achieving a financial goal and everything is on track, you should not be rebalancing. There's no point rebalancing, because every time you rebalance, you pay tax and you incur costs, transaction charges. You do not want that. Rebalancing should primarily be driven if the investments that you're making no more align with your financial goals. This can happen in two ways. Either your financial goal itself changes, or the investments that you made apparently didn't turn out the way you wanted. Maybe you made the wrong investment call, which is absolutely fine and very natural. Not everybody makes the best investment decision. Maybe you chose a mutual fund that was not right for you, or your financial goal changed. Maybe you were saving up to buy that one car that you've been dying to buy, but now you no more want to buy that. So your investment goal has changed. That money should be allocated elsewhere to another financial goal, right? So these two are the primary events which should decide when are you rebalancing your portfolio. Now, how you should be rebalancing your portfolio is again a function of these. If you think that your goal requires more returns, primarily driven by what your expectations are and how far is your investment goal and how much money do you need, how much returns should you be generating to achieve that goal. If you think maybe return expectations should be slightly higher, you can opt for a riskier product. But if you think that investment goal is, let's say, 1 2 years down the line, I'm almost there. Even if I don't make a lot of money on my investments, I'll still be able to achieve the goal. Rebalance the portfolio rather than staying invested in equity. Take that money out. Set up an STP into a debt mutual fund. So this letting your financial goals and letting your financial goals and your mutual fund performance decide how frequently do you rebalance your mutual fund portfolio will actually be a more systematic and methodological way than listening to your colleague who's recommended कि ये वाला mutual fund बहुत अच्छा कर रहा है तो अपना बेच दे मेरा खरीद. So I guess following a more systematic approach with a very logical step flows actually be much better than being very random about your investment.
Yes. I mean, I hope everyone has actually understood whatever we spoke in this session. Also, the much awaited moment is here. You can actually shoot in your questions and ask Kashish about how you can actually make your investment plans and everything finance related. So, in the meanwhile, Kashish, I'll take up the last question from my end. What advice do you have for beginners who are just starting to invest in mutual funds, and what are the resources that they should continue to use in terms of learning more about investing?
Yeah. So I guess the best advice would be start right away. I mean, the sooner you start, the better it is for you and your financial goals. So the sooner the better, honestly. Start right away. And once you've started, right, आपने अपनी SIP start कर दी, do not stop it. Do not at any point try to be smart and try to play around with your investments. Be very conservative and be very thoughtful about your investments. As far as resources go, honestly, there are a lot of people out there who have created large number of resources, including myself or anybody out there. And on every platform की भी कमी नहीं है. You go on YouTube, you have resources. You go on LinkedIn, you have resources. You on Twitter, you have resources. A simple Google search. There are a lot of resources out there. I guess the best for you would be sticking to just one resource, study it well enough, and then start applying it. Because honestly, Purnima hota kya hai, once we get into that phase of start learning, right, it almost becomes an addiction where we want to learn more before we start applying. And that is when the whole purpose of your exercise fails. The reason you are learning about, let's say, investments is because you should start acting on it as well. People forget the action part and continue their learning part. I mean, if you're very fascinated by this world, go ahead. But you also have a job, you have a life, and the main reason you started this was because you wanted to take action in your financial plan. So refer whatever resources you think suit you best, but start taking action. I guess that will be a key takeaway I would want the audience to leave this session with.
Lovely. We're all blessed to have a speaker like you in this session today. And we have a lot of public questions. Taking the first one from Vriddhi. I use mutual funds to save for a specific goal, like a down payment on a house or a college. So she's asking, can she use mutual funds for a down payment of a house or maybe her college education?
Yeah, totally. So as I always said, right, your investment should be driven by a financial goal. First, identify that goal. वो goal है क्या? Then identify what's the amount required. Is it 10 lakh? Is it a crore? Then identify how near is that goal. Is it a 1 year goal, a 5 year goal, a 10 year goal? Then identify the mutual fund. Once you've answered all these questions, right, it becomes easier for you to choose the right mutual fund and where to invest. Let's say, let me take an example here. If the audience member here, Riddhi, was saving up for a down payment for a home loan, for a home. Let's say she would want to buy that home in next 2 years. Now, we know for a fact 2 years is not that big enough time horizon. If it's not that big enough time horizon, we also cannot take a lot of risk. We also cannot invest in asset classes like equity, जहाँ पे market can be volatile. So she should stick to investing in a debt mutual fund. For example, a very generic example, she should stick investing to a debt mutual fund. कि वो 2 साल तक invest करे. She saves up enough and then uses that amount to fulfill her down payment for that house, for that home loan. So identify the goal, the amount required, the time horizon, and then choose a mutual fund. The whole process becomes very simple there. And then it also becomes very automatic. You don't have to again start researching ki kaun sa mutual fund mere liye sahi. No. It becomes almost automatic once you've understood the very basic principle of how money works.
So, Chetna asks if your mutual fund has grown, for example, by 20%, and you are not in an urgent need of money, should you withdraw or keep it?
So again, Chetna, it is all about a financial goal. If you do not have a financial goal, you should not be investing. And even if you're investing without a financial goal, the ultimate financial goal remains financial independence. That is, you need not work for money. Well, you can still continue working because you love working, but you are not no more compelled to work for money. So that's the concept of being financially independent. If your aim is to be financially independent, answer it for yourself. Will 20% return help you achieve that goal? If not, it doesn't make sense for you to withdraw or book. Again, because you have to understand you're in it for the long, depending on your financial goal. If you are, let's say, investing for retirement and you are to retire, let's say, 10, 20 years down the line, whether you make 20% this year, 30% this year, even a 10% this year, it's irrelevant. It remains irrelevant. But, but if you were saving for a goal that is 1 year down the line, जिसके लिए 20% चाहिए था, and you made it, then it's better to withdraw because you already have achieved the goal. You can keep it in your FD or a bank account, much more safer, and have that comfort of cash as well. At the same time, achieve your goal. So the answer to every question, I guess, here would be a function of your financial goals. How much money do you need? How far is it? And all your investment or mutual fund related queries get answered with this framework.
Yes. So Bhavtosh requests you to talk a little bit about SIP once again, and he says that he's planning to start investing through his bank ICIC, and so he asks if there are any disadvantages associated too.
Yeah. So there is never a word called trying. Either you do or you do not. So
Yeah.
if he says so, he's still confused. And I hope that I'm able to incentivize him to start investing today onwards. As far as investing through ICICI goes, again, it doesn't really matter a lot because what matters is you are investing consistently and you're investing at the right place and you are being very logical and very fundamentally approaching the problem of investment. So whether you do it through PhonePe like me, through Grow like somebody else, through Zerodha like somebody else, or through an ICICI, doesn't really matter till the time it helps you achieve your financial goals. So there is no advantage per se. The funds that you invest in through ICICI might be slightly more expensive because they will be regular plans. So regular plan में क्या होता है, where there is a distributor who is distributing a product to you. So maybe if you're investing, the expense ratio will be slightly higher. Still, it becomes irrelevant because if you stick to that investment long enough, you still will be able to achieve the goal even if the expense ratio is high. Answering the first question, explain more about SIP. Just start. SIP is the most wonderful creation, I guess, of mutual fund industry. Because once you start an SIP, you forget about it. मतलब आप भूल जाते हो, हर महीना पैसा कटता रहता है. At the end of the year, you realize you've saved so much, you've made so much money with zero effort. Had you been not doing SIPs and you were constantly making the decision each month कि आज मुझे यहाँ invest करना है, there was a lot of friction involved. SIP makes the process very frictionless.
Simpler,
And
yes.
even the apps right now are so frictionless, you can set up an SIP within 5 minutes.
Yes.
And even more importantly, set up the SIP on the very first day you receive your salary. Just make sure that you do not end up spending that salary on booze or something that you shouldn't be
Right.
buying in the first.
Right. Right.
So if I look at it, SIP is the most wonderful creation made for Indian retail investors. And I mean, testimony to this is that as of today, monthly SIP amount for mutual fund industry is 12,000 crores, if I'm not wrong. So 12,000 crores worth of investments are made through SIP in India. The fact that this amount is increasing should answer your question, what is SIP? Why is it important? So I guess, yeah.
Also, Vaibhav asks, should I invest or should I start investing as a fresher before having a complete emergency fund?
Yeah. So Vaibhav asks a very wonderful question, honestly. You should not start investing in mutual funds because even I mentioned till the time you have your insurances and your emergency fund. You should have an emergency fund and an insurance. And I'll give you a very simple example for this, a very simple one. Everybody's seen pyramids. Pyramid was regarded as the one of the most spectacular man-made architectural masterpiece.
Creation.
Right? Bilkul, it's top of the class. Pyramid has a wide base and a ऊपर का it's thin. So basically, and it remained one of the tallest structures up until recently. For anybody to build that pyramid, for the Egyptian kings to build that pyramid, they had to make sure that the foundation was strong. Because had the foundation not been strong, it doesn't matter how up you go, the likelihood of that thing disrupting, falling is very high. So you as a individual are planning, ki boss, the height of the this thing, my pyramid is my net worth. The higher it goes, the better it is for me. You're absolutely right. But you cannot have that thing go higher till the time your foundation isn't right. For you to build that foundation, you need an emergency fund, a term plan, and a health insurance. Because Kalko, a very simple example. Let's say, Khuda na khasta, you go through an medical emergency that rips off your investment portfolio. You would not be comfortable selling all the investments you've made in past. You're better off having an emergency fund, buying that insurance. Ki kal ko your insurance is financially supporting you. You do not want yourself to break that flow, to let that structure that you're building fall apart solely because of an emergency situation, which can be related to health, even maybe job loss. आप नहीं चाहते job loss में you stop your SIPs and actually start taking money back for a financial goal like रिटायरमेंट के लिए पैसा इकट्ठा कर रहे थे, अब आप जॉब लॉस की वजह से वो वापस दे रहे हो. You should have an emergency fund of at least 3 to 6 months of expense to make sure that you do not have to run back to your investments to sustain you.
Well, moving to the last question of the session. What is the best platform to invest? ET Money or Deserve?
I personally use PhonePe, so PhonePe is the best platform for me. And I may be even biased because PhonePe is my employer, right? With that being said, honestly, see, the best platform is the one that gives you the right products at the right time and lets you stay invested in them long enough. If you are going for a platform जहाँ पे हजारों म्यूचुअल फंड दिखा दिए, जिसमें दिखा दिया this is the best performing mutual fund for past 3 months, go invest in it right now, their incentives are skewed. You should not be comfortable investing in a platform जो हर 3 महीने बाद आपको नया फंड इन्वेस्ट करने को कह रहे हैं, because you know 3 to 4 mutual funds are the only thing you need. So if there's a platform which is giving you all these recommendations and incentivizing you to buy and sell and buy and sell, that is not the right platform for you. And that is why I personally also use PhonePe, the mutual fund app, Wealth app, because it gives me a very simple list. Okay, these are relatively good. These are the ones selected by PhonePe research team. So I invest there and I'm happy with it. So your best would be the one that leads you to achieving the financial goal. Because now every app is seamless. ऐसा नहीं है कि एक ऐप में एक क्लिक से हो रहा है, दूसरे ऐप में 10 क्लिक से. Every app is seamless. Investment journey everywhere is smooth. The only thing matters is what their incentives are, and you can easily make it out from actions like these. कि how many times do they send me a phone notification? ये नया फंड आया है, इसको खरीद लो. ये आया है ये. Fine. So I guess that could maybe answer the question. Yeah.
Yes. So I'm very happy that I got a chance to conduct this session today, and it was a really insightful and informative session and very easy to understand. And I hope my viewers and everyone who's watching us feel the same. We were in conversation with Kashish Kapoor. Thank you so much, Kashish, and it was a lovely chat. Thank you so much.
Thank you for having me, too.
Thank you.